Your point on VIX, I thought was very interesting as well. I've noticed this too. It's almost like VIX is broken. Like, how come VIX isn't, even when you see these mild down days, we really haven't had any severe down days. I don't think we've had like a 2% down day in like over 100 days, right? But let me challenge you on this one. I'd love to get your perspective, which is that there is volatility, but it's not in the Max 7. The volatility is everywhere else. And the definition of the VIX, which looks at the money, implied volatility for vascular securities, and then it weights them with an algorithm, that is weighted towards those Max 7 names. But we are seeing volatility and downside volatility outside of that category with the breadth deterioration. So is it that maybe the volatility is there, but we're not measuring it in the correct way, or the volatility is just an area that's outside the yardstick?
I think what you pointed out are early indications of cracks in the very low complacency or high complacency market that I view as it's just a tinderbox waiting to spark. It needs a catalyst. We get some normal, just a normal things that used to happen in normal markets, in bull markets, and say I'm using the S&P 500. It's basically beta for the world. A normal 10% correction. This year we've only had 5%. The bottom last year in October was 10%. And I wanted, to me, I've been writing about that. Let me get through that test so I can really make decisions about being bullish Bitcoin, because it failed on the 5% correction. So my thing I like to point out is I compare everything to beta S&P 500. So you look at crude oil, the number one commodity on the planet. It's been stuck in a narrowing wedge pattern for almost 2 years now, and it's on the back end, which normally does in crude oil. It's very rare for it to go up to 90. And if it does, it makes the whole economy tilt lower. And it's very normal since 1981 to go down to 40. To me, that's part of why I wanted to push back a little bit earlier. I think we're heading towards a normal, pretty severe deflationary cycle in the aftermath of the biggest money pump and liquidity pump in history. So let me just give you my macro that I was early on. I'm pointing out is, and I can mention 3 or 4 books. I love your bookshelf that pointed this out. That is, in the history of mankind, in history of markets, when you have a massive pump in liquidity and assets rise, they almost always come back down and hard. Price of Time was one by William Chancellor. Boom and Bust by Quinn. I forget the other author. And I've tested that in the system. So that's happening in some commodities. I think it's just a matter of time to happen in risk assets. So we're just getting past this period, unprecedented, where we had 0 to negative interest rates in most of the rest of the world. We pumped up prices of all assets to where we are, which is logical. And now that that is ending. And it's just a matter of time. So from a commodity standpoint, I see nothing but deflation. So let's look at the number one measure of heat, electricity, and fertilizer in this country. Natural gas, partly because of the Russians' invasion of Ukraine, pumped up to 10, and it dropped down to 1.4 this year. Right now, it's around 2 and change. That's an 80% correction. It's at the same price as it first traded in 1990. At least it got to that level. You look at crude oil, price of $83 a barrel. I mean, that the high was 130. I think it's going to 40. That's just a normal cycle, because what commodities almost always do, the lessons of Adam Smith, is they have to get below their cost of production. The cost of production in the U.S. is 55, the world's largest producer. And we've done that partly for demographics, but mostly because of advancing and harnessing that technology. And here's one thing that just happened last week. The number one measure of, like, what crude oil is to energy, corn is to food. It's the most significant food on the planet, and it's also energy. The price of corn right now, around 4, was first traded in 1974. It's plunging because of one major reason. We had the biggest pump in prices in 2022 to 8 in 10 years. And there's so much elasticity from that. The Price of Tomorrow by Jeff Booth and Adam Smith, that all that supply is coming on this year. Unless we get a bad year, we're going to have we have too much supply left over from last year. It's a normal cycle in commodities. And the only thing, I think, the thing that's holding everything up is this U.S. stock market capitalization versus GDP. And the Fed knows they can't really cut rates, because I think Mr. Powell knows he tilted towards telling market he's going to cut rates too soon, but all the data is starting to tilt the other way. You look at unemployment. Our economics team thinks that payrolls are not as significant. Unemployment's probably going to go to 4.4% this year. The lowest 3.4%. It's never bottomed from that level without going to 6%. So to my whole macro thing is a normal cycle is going that way. And the key thing to watch is China. So I'll end with this. I bought a Chevy Volt. Oh, it's 10 years old now. That's a plug-in hybrid, 2014. I've got 10 years on it, 80,000 miles. It's a great vehicle. It cost me in dollars 10 years ago, 36 grand with subsidies, 29 grand. Right now, you can buy a BYD, gets triple the mileage, and it's a fraction of the cost. and it's a good car. And we have to have tariffs to keep that from coming in the market into this country. Yet it's just a sign of significant deflation coming our way. And what do we stop? And the one thing that's keeping us away from deflation is the U.S. stock market remaining elevated, is the way I see it.
Fascinating. I really appreciate that. So your thesis is that, hey, we're going to see economic softening. This is yet another cycle. We've seen cycles before. Look at the ratio of financial assets to real assets. They're overpriced. Things are going to roll over, and the Fed's behind the curve, and therefore there be dragons.